Okay, let's focus on select stocks, and Cummins is under some pressure. Remember, they've cut their guidance both on the international business as well as the domestic business. Anisha was listening in to their call just around an hour or so ago. She joins in to fill us in with all those highlights. Anisha, the stock is not taking it well. We're down at the low point of the day, down close to 7%.
Oh, well, yes, the Q1 numbers were as it is weak. The margin performance was not good at all. And now the management commentary is also very, very weak. In fact, they've cut the guidance, as you mentioned, on both the domestic as well as export front. Export was largely expected because in Q1 there was a decline of 26%. That made it very clear that the initial guidance of 0 to 5% decline would not be met. But the cuts are larger than what the street estimated. So now they're expecting that the export revenue will decline by around 5 to 10%. And they're saying that for the coming 2 to 3 quarters, there is uncertainty. The trade war is having an impact, and that is why it remains a bit of overhang for the company performance. Even on domestic front, just in May, the company sounded very confident. In fact, they said they were very optimistic and that they were expecting a 10 to 15% growth. But things seem to have changed in the last 2 to 3 months itself, because now they have cut down their guidance to 8 to 10%, and that compares to the 10 to 15% guidance that they had given in the month of March. They say that it is the industrial as well as construction segment that is very weak, and in fact, they expect that the construction revenue will remain flat year on year. On margins also, there were a lot of questions because the margins had declined by 500 bips year on year. The management said that perhaps they have seen the worst of the margins because there was some one-off discretionary spend as well as some commodity pressure this quarter. But going forward, they're expecting some kind of improvement, and the normal margin perhaps could be 12.5%, 13% versus the 16% that we had seen last year. And the tax rate is also expected to go up. So I'm expecting further cuts to come in from the brokerages as well.
Okay, Anisha, what about Siemens? Because that's higher by close to about 6.5%. They've called off the sale of this mobility unit.
Yeah.
How significant is that, and why was it an overhang on the company?
Well, Rima, what was happening with all of these MNC companies was they used to take out the businesses, carve them out and sell it to the parent company, and the shareholders just used to get one-time perhaps dividend or some kind of special dividend, but the revenue income that was being generated by all of these segments used to go away. Now, remember the Alstom deal that was signed with the global parent got called off, and that is why it was expected earlier as well that perhaps this deal to carve out the mobility as well as the mechanical drive business would be called off. In fact, at the end of last quarter itself, the company had formed a committee to see the terms and conditions of this particular sale, and now on expected lines, the company has put on hold the plans to carve out the mobility as well as the mechanical drive business. In terms of the quarterly performance also, Rima, the numbers were quite good because the margins expanded. There were some one-offs, so if you strip them off, the margins came much better than expectations. Even if the revenue growth was quite tepid, the company managed to meet the estimates on the bottom line because of the good margin performance. And even if you look at the gas and power segment, the margins expanded by 500 bips, and mobility business saw stellar growth of around 17% on top line and a margin expansion of 440 bips. So you can understand why the street is happy that business is not going away.
Okay, all right. Thanks so much for joining in, Anisha, and filling us in with those details. But let's hop across to Mangalam. Emami came out with a set of numbers. Mangalam, how were they?
Well, Nigel, they were muted as compared to the top line expectations. The EBITDA was higher. The stock had corrected around 50% from the top end, which is why we're seeing some bit of recovery on that counter. So take you through the numbers. Revenue growth at around 5.5% was pretty much in line with the mid-single digit sort of growth that the street was working with. So that was okay. Gross margins, they came off by about 200 basis points, but the EBITDA jumped by about 11%, and that's primarily because the ad revenue or ad expenses came down by around 10%. Remember, at close to 20% of overall sales, Emami is the highest ad spender. So the minute they cut down on ad spends, the effect immediately shows on the EBITDA. At the same time, we saw the net profit get a boost also from the higher other income that came by. The other income factor was at around 12 crore. This compares with around 5 crores. But the management commentary, that did not seem too positive. They said the quarter witnessed challenges in terms of adverse economic conditions. Most of their sectors, be it pain management, male grooming, BoroPlus, healthcare, all of them performed below expectations. The international business, that one did well, grew 34%. But remember, that had been underperforming for a very long time. So that's coming off a low base. And while they believe that, things would look good going ahead, but that is something that, is a hope that all the FMCG companies are playing on right now.
Thank you very much, Mangalam, for joining in. We'll get into a break on that note. On the other side, Welspun Corp has reported a good set of Q1 numbers. The stock, however, is down 1%. Vipul Mathur, the MD and CEO of the company, on the other side. Welcome back. Let's straight away move on to Welspun Corp. That's reported a good set of Q1 numbers. Revenues have gone up by 25% on the back of better realizations. And the company has reported a profit figure of 118 crore, which compares with 43 crores in the comparable quarter of last year. Vipul Mathur, the MD and CEO of the company, joins in now. Mr. Mathur, I want to talk about the company's outlook because in the release you're saying we're confident of an improved operational performance from Q2 as the pace of project execution is picked up consequent to the formation of the stable government. What are you expecting in the coming quarters in terms of revenues as well as operational margins?
So, a very good afternoon to you. Thanks for having me on this show. In this particular quarter, the performance has been fairly robust. We have done almost 319,000 tons of sales, which is almost 19% up on a Y-on-Y basis. And if you look at it, our EBITDA also, which is close to 260 crore rupees, which is 49% up on a Y-on-Y basis. And so is the case with PBT and PAT. Now, this performance has largely been due to the great performance which has been done by our US unit. The Indian performance has been a little lukewarm, and we have this code of conducts in place, and and then a new government coming in place. So the financial allocations and everything now has happened. So to that extent, there has been a little bit of a drop in the sales volume. Which we have seen in the Q1, but now with everything now in place, we are going to see a sort of a very robust performance coming out of from India as well in Q2. So in Q2, what we can expect is a robust performance out of India as well as in US. And in any case, as you must have noticed, our performance in Saudi Arabia joint venture also has significantly ramped up. And we have, they have also delivered a record performance of delivering 138,000 tons of production. So all in Q2, I think so. Summing up all three of them, we will see even a much better performance what we are seeing in Q1.
Okay, Mr. Mathur, let's break it up, into various geographies. Then let's talk about the U.S. business first. I'm looking at those numbers. It appears you're doing $35 million, approximately in the last quarter. Were there any one-offs in there? Were there some inventory gains? And if you could give us a rough quarterly run rate we should look at in terms of EBITDA for the US business. And the other positive is your Saudi business, the JV that you were talking about. Out there, you turned EBITDA positive and PBT positive as well. We should look forward to you staying in the green on the PBT as well as the EBITDA basis going ahead as well?
So, let's talk of the US first. I think so in this particular quarter, there was a little bit of a top up of some old inventory which was available with us for earlier projects, which got liquidated, which got moved out. So there is a small component of that EBITDA, small component of that profits which is sitting into the EBITDA at this point of time. In subsequent, so to that extent, it will get mitigated in the subsequent quarter. But having said that, the robust order booking what we have at this point of time in US and the profitability what we are seeing in our existing orders, I think so sort of a similar run rate, both in terms of volumes and profitability should continue. As regards Saudi operations, as we said, the pain in Saudi is over. If you recollect, in Q4, we turned EBITDA positive, and in Q1, we have now turned PBT positive as well. And we have an order backlog of almost 650,000 tons in our Saudi operations, which will keep us busy for at least next 18 to 24 months. And all these orders seems to be extremely profitable. And from here on, we would see an improvement only, and we are not looking back at all in Saudi at all at this point of time.
Mr. Mathur, just one number. What was the extent of the one-off benefit in your US operations? If you could give it in terms of volumes, in value, any number.
It would be close to, let's say it would be close to $5 or $6 million. That's it.
5 or 6 million. Okay.
So then going ahead, you're saying around $30 million is what you're looking at in terms of an EBITDA for the US operations. Is that correct?
Broadly.
Right. And in terms of the Saudi operations, you said you're looking to build onto this performance. I'm looking at EBITDA per ton. You have done around $40 per ton in the previous quarter. That's in Q4. Now you're doing $90 per ton, and that gives you a run rate of more than $10 million per quarter. So that's what you're likely to do.
Our guidance is the same. In Saudi operations, we should be close to $100 in EBITDA per ton basis. Yes.
Okay.
100, okay. So you will maintain that. What about your net debt? Currently stands at $1.9 billion, $1.959 billion. You have been bringing it down. What is your guidance on reducing your debt from these levels, say by the end of FY20?
So on the net debt, if you see, we are at 196 crore rupees in this last quarter. In this quarter itself, we have reduced it by additional 90 crore rupees, and now it's standing at 196. We are pretty much on track to the guidance what we have given, that we would love to, we would like to be a debt-free company in net debt-free company in 2020, and we are pretty much on track. And with 196 crore rupees, only the net debt which is sitting, we are more than confident that we should be able to achieve this target sooner rather than later.
Okay, all right, Mr. Mathur, thanks so much for joining in. The stock is reacting to your commentary and you're sounding quite optimistic. It's recovered from the low point of the day, but otherwise, the stock has seen a lot of selling in line with what's going up in the mid-cap space. You pull up a last 3-month chart, I think the stock has corrected from around that 140 rupees all the way to around this 115 rupee odd mark. Well, we'll slip in a short break. You come back on the other side, we'll shift focus to the commodity segment. Stay with us.